Hello everyone. In this video we are going to learn about bond risk. Risk in finance is the difference between actual gain and expected gain. Every investment product is associated with some amount of risk and every investor has unique risk profile. Some may be willing to take higher risk while others may prefer to avoid risk. The fundamental idea here is the relationship between the risk and return. The greater the amount of risk an investor is willing to take, the greater the potential return and vice versa. Generally, stocks are considered to be risky but bonds are not. This is not absolutely correct. Bonds do carry risk but the nature and type of risk may be different. The following are different types of risk. First one, interest rate risk, default or credit risk, inflation risk, reinvestment risk, liquidity risk, callability risk, market risk and rating risk. Let's see all these things one by one. First one, interest rate risk. When interest rate falls, bond prices rise, and when interest rate rise, bond price falls. Interest rate risk is the risk that changes in the interest rate may reduce or increase the market value of the bond investor hold. Interest rate risk can be reduced by holding the bonds of different durations, and investors may also ally interest rate risk by hedging fixed income investment with interest rate swaps, options or other interest rate derivatives. Interest rates on different investment products are subject to fluctuations. It may go up or come down based on different market factors. It always makes investment risky. Here under bond, these interest rates variations cause changes in the bond prices. There is an inverse relationship between the bond price and interest rate. Bond investors are usually concerned about the bond prices. To secure themselves against interest rate risk, an investor should try to hedge fixed income investment with interest rate derivatives. Default risk or credit risk. This is the risk that an issuer will be unable to make interest or principal payments when they are due and therefore default. Rating agencies such as Moody's, Standard and Poor and Fitch assess the credit worthiness of issuers and assign a credit rating based on their ability to repay its obligations. Fixed income investors examine the ratings of an issuer in order to establish the credit risk of the bond. Ratings range from AAA to D. Bonds with the ratings at or near AAA are considered very likely to be repaid, while bonds with the ratings of D are considered to be more likely to default and thus are considered more speculative and subject to more price volatility. Here the company is failing to repay the money to the investor. In case of bonds, the investors are giving credit to the company which has to be refunded or returned to the investor on the maturity of the bond. Due to some reasons, if the company fails to repay this money back, we can say that the company is in default and it is called default risk. To avoid this risk, an investor should make a proper analysis before taking investment decisions. They have to check the ratings given to the company by credit rating agencies and they should invest in those companies which has good credit ratings. Inflation risk. Inflation reduces the purchasing power of a bond's future coupon and principal. As bonds tend not to offer extraordinarily high returns, they are particularly vulnerable when inflation rises. Inflation may lead to higher interest rates, which is negative for bond prices. Inflation linked bonds are structured to protect investors from risk of inflation. The coupon streams and the principal increase in align with the rate of inflation, and therefore investors are protected from the threat of inflation. Inflation is the situation where the prices of the product are high but the value of money is low. Therefore, it is said that inflation means too much money chasing too few products. Inflation in general affects the entire economy. Bond investments are not an exception to this. Inflation leads to the higher interest rates, which in turn results in lower bond prices, which is not good for the investors. Here, inflation linked bonds help the investor to protect themselves against the inflation risk. Reinvestment risk. When interest rates are declining, investors may have to reinvest their coupon income and their principal at maturity at lower privileging rates. The probability that investors will not be able to reinvest the cash flows at a rate comparable to the bond's current return refers to reinvestment risk. This tends to happen when market rates are lower than the bond's coupon rate. Usually, reinvestment risk is connected to interest rates. Investors here interest rates are fluctuating in nature, which may lead an investor to reinvest his bond's cash flows at a rate lower than the expected rate of return assumed at the time of buying the bond. If the maturity is longer or coupon rate is higher, the reinvestment risk will be higher. Liquidity risk. This is the risk that investor may have difficulty finding a buyer when they want to sell and may be forced to sell at a significant discount to the market value. To minimize this risk, investors may wish to opt for bonds that are part of large issue size and also most recently issued. Bonds tend to be most liquid in the period immediately after issue. Liquidity risk is usually lower for government bonds than the corporate bonds. This is because of the extremely large issue size of most government bonds. Liquidity means convertibility of the security into cash without wasting time and value. Liquidity risk arises when the investor finds difficulties in selling or converting the bond into cash. Investors can avoid this risk by investing in those bonds which have good demand in the market. Mostly the large issue and recently issued bonds or government's bonds are considered as liquid, which can be considered as a good mode of investment. Callability risk. The uncertainty created for investors' return by the issuer's ability to call the bonds at any time is known as callability risk. Debt instruments used to carry call option. Since the bonds or debentures can be called at any time, there is uncertainty regarding the maturity period. This feature of the bond may depress the price of the bond, and the uncertainty element attached to the callability bond makes the investor ask for higher yields. The call option provides the issuer the right to call back the instruments by redeeming them. This is useful to the issuer when the market interest rates are declining. He can avoid paying higher prices to the bonds. The issuer can call the bonds with the higher interest rates and again raise funds at a lower rates. This leads to uncertainty to the bondholder, which creates callability risk. Market risk or systematic risk. Market risk is the probability of losses due to market reasons like slowdown and changes in rates. Market risk affects the entire market together. In a bond market, no matter how good an investment is, it is bound to lose value when the market declines. Interest rate risk is another form of market risk. Security market is subject to fluctuations. It creates uncertainty to the investors about their return on investment. Since this uncertainty is applicable to the entire market, this risk is called market risk or systematic risk. This is a common risk which can be found in any market. Rating risk. Bond investment can also sometimes suffer from rating risk, where a slew of factors specific to the bond as well as the market environment affect the bond rating, thus creating the value and demand of the bond. Bond investors usually study the ratings before taking investment decisions. If the ratings are good, people prefer to invest in those bonds. Here several factors regarding the bonds are considered before giving ratings to the bonds by credit rating agencies. Sometimes these factors can adversely affect the bond rating, leading to decrease in the value of the bond or demand for the bonds. It usually affects the company than the investors. These are the different types of risk related to bonds. Thank you.